Hello and welcome to the Business Standard Morning Show. I am Ruchika Chitravanshi. It is 2nd of August 2023 and here are the questions we will be answering today. Why is Maruti buying its parents' unit in Gujarat? Why is buying a house costlier in Mumbai than in Dubai? Has fundraising via DVRs run its course? And what is a semiconductor? Maruti Suzuki India is set to acquire parent Suzuki Motors manufacturing facility in Gujarat. India's largest car maker plans to wind up the deal to purchase its contract manufacturing partner Suzuki Motor Gujarat by March 31st next year. But why is Maruti Suzuki buying its parent's unit in Gujarat? Is there more to it than what meets the eye? Abhijit and Bhaswar Kumar bring you the answer.
On July 31st, Maruti Suzuki India announced that its board had approved the acquisition of the entire stake in Suzuki Motor Gujarat from Japan-based parent Suzuki Motor Corporation. Suzuki Motor Corporation currently owns a 100% stake in Suzuki Motor Gujarat, which supplies its entire production to Maruti Suzuki. The acquisition is subject to all legal and regulatory compliances, including minority shareholders' approval. The board has also approved the termination of the contract manufacturing agreement with Suzuki Motor Gujarat. The decision over the mode of acquisition and consideration to be paid to Suzuki Motor Corporation will be decided in subsequent board meetings. The auto major expects the transaction to be completed by March 31st, 2024. India's auto industry is growing and has export potential. With the acquisition, Maruti Suzuki says it aims to increase its production capacity. To meet its carbon neutrality requirements, the company said the production capacity for drivetrain technologies like EV, CNG, and ethanol, among others, needs to be augmented. Maruti Suzuki is focusing on consolidating all its production and production-related activities under a single management. So, let's understand from Dilip Chinoy the rationale behind the company's acquisition move.
I think when you were looking at 2014, right, the capacity utilization of that plant was not significant. So if as a company, the investment would be very heavy and the capacity utilization low and it would impact profitability and impact your books. You have a completely operational plant, right? And you are still looking at contract manufacturing, and the way it is done is, doesn't give you the flexibility, doesn't give you the ability to change product mix, even though there is some joint shareholding in both the companies. So it makes sense for Maruti to look at this. If they're buying the plant, we don't know what Suzuki is going to do with the money.
The move comes amid a profitable first quarter for Maruti Suzuki India on the back of car sales recovery and easing supply chain disruptions. The company reported a jump of 145% year-on-year in net profit in the quarter ending June 2023, sitting on a massive cash reserve of more than 45,000 crore rupees. As of April 1st, the company has been focusing on manufacturing expansion for some time. In April, Maruti Suzuki India announced its plan to set up a new plant in order to increase its annual capacity by 1 million units. Another plant in Kharkhoda, Haryana, is expected to boost production by 1 million units. Chairman R.C. Bhargava had also stressed that the company would not resort to borrowing for expansion, but use its internal resources. After the announcement of the acquisition, Bhargava told journalists that the production, cost, and profits of Maruti Suzuki India will not be impacted. But what makes Bhargava so bullish on this acquisition?
So supposing you were to take the dynamics of it and you're producing a car for 100 and the outsourcing cost is 80, right? And you're doing 300,000 cars a year, right? If you do 300,000 into 80, if any cost of the plant is less than that, then obviously it's not going to impact your balance sheet, right? There will be a cash flow issue and there will be another issue, right? So the deal structuring will be quite important.
the commercial contours of the transactions are not fully made public. They'll take some time. I think it is not just the payment for buying the plant, but also the value created in having integrated manufacturing within Maruti, which one should evaluate. So you cannot just evaluate what's going out in terms of the current payment. We should also, over time, over year after year, the additional value added because of that manufacturing plant into Maruti shareholders' value creation. That should be evaluated together.
However, in 2014, Maruti Suzuki India had defended the plan that the Hansalpur, Gujarat-based Suzuki Motor plant would be owned fully by Suzuki Motor Corporation. It faced backlash from investors and other stakeholders who feared that Suzuki Motor Corporation would own the plant and sell cars to Maruti Suzuki India on its own terms, turning the latter into a mere marketing arm. Bhargava had defended the decision back then, saying the cash reserves of Maruti Suzuki India, which were over 7,500 crore rupees, fetched 8 to 9% return as interest. This interest income would have come down if Maruti Suzuki India had funded the Gujarat plant out of its cash reserve. Meanwhile, Suzuki Motor Corporation was earning only 1% interest on its cash reserves of 25,000 crore rupees in Japan. So, the investment would enhance their returns, he had said. Bhargava had portrayed the deal as a win-win for both companies. So, what has led to the apparent change in stance by Maruti Suzuki India now?
At the time when they did in this contract manufacturing arrangement, see the cycle of the automotive industry was declining. Now, what has changed significantly is that the Indian market is growing. They also have a stated objective. They always want to be, above 45, close to 50% of the Indian market. And therefore, they're entering into new segments, right? And looking at different aspects. So the circumstances have changed, right? Remember, Maruti are very frugal companies. They compete at the lowest end of the market, right? I don't believe it's a reversal of stand. The circumstances have changed, so it makes sense to do this now.
In 2014, I think the environment that time was different. Maruti had not come up the curve in terms of exports. Maruti also had various challenges at that point in time. And today the things are very different for Maruti, at least in terms of business perspective. They need to now increase their capacity to meet with the demand of the product. And they need to take charge of the production much more than any time before.
Meanwhile, at the bourses, Maruti Suzuki's share ended 1.2% lower on Tuesday, as the company's operating margin weakened in the June quarter. Investors also factored in a reduction in the earnings per share due to possible equity dilution for the Suzuki Motor Gujarat deal.
The Gujarat plant, after generating cash flows from Maruti, increasing the capacity to about 7.5 lakh units per annum, creating value, is now being sold at over 12,700 crores to Maruti itself. Shareholders surely are not happy with this development, as it would reduce the EPS as well as return on capital employed. This may weigh on the stock performance from a short to medium-term perspective.
Experts are of the opinion that the acquisition will prove beneficial for the auto major. The streamlined management of manufacturing is expected to give greater autonomy to Maruti Suzuki India in terms of production capacity and carbon neutral goals.
Sales of passenger cars breached the 2 million mark in the first half of the ongoing calendar year for the first time. New launches by Maruti, Hyundai, Tatas and Mahindra are selling like hotcakes. Indians are loosening their purse strings like never before. And like the cars, demand for residential properties are also outstripping supply. No wonder the prices are shooting through the roof. Properties in parts of Dubai have become more affordable than in the suburbs of Mumbai. But why so? Tariq Ahmed takes a look at the price cards.
More and more wealthy Indians are adding a new residential address to their list of assets. But it is not in India. They are finding greener pastures in a distant desert city, that is Dubai. And the reasons are many. The quality of life in this city is comparable to any other top global city. Its property market is highly regulated, which protects investors' interests. The city offers rental yields of 6 to 10% and it also offers various property-linked visas. No wonder Indians spent 35,500 crore rupees to own Dubai homes in 2022. According to the affordable housing pioneer Danube Group, 45 to 50% of the residential properties that were sold by them in 2022 were bought by Indians. The affordable prices and better amenities are attracting Indians to buy properties in Dubai. The fully furnished 400 to 500 square feet properties are available at a price of 1.45 crore rupees. An assured return on rentals due to steady flow of expats into Dubai makes its properties more attractive to the Indians across the world. But back home, in the country's financial capital Mumbai, property rates in prime localities have left Dubai behind. Properties between Andheri and Santa Cruz area are being sold at 50,000 to 1 lakh rupees per square feet. According to the Knight Frank Dubai destination report, in the lowest bracket, residential properties are available in many places in Dubai between 11,000 rupees and 33,000 rupees per square feet. Dubai Science Park, Jumeirah Village Circle, International City and Jebel Ali are few of the places in this lowest bracket. Also, according to the Knight Frank data, more than 56% of the property that registered in Mumbai during the first half of 2023 is priced above 1 crore rupees. So the properties in some parts of Mumbai are costlier than those in parts of Dubai. But why?
Look, Mumbai's real estate has a distinct advantage in the country. Mumbai remains the financial capital of the country, and hence the residents or the occupiers or those who seek accommodation in this city can afford to pay high rates for the luxury property, for uber luxury properties. Point number one. Point number two is Mumbai has always been known as an island city. And this is an infrastructure perspective also has been troubling this city because the land values in this city have been skyrocketing in compared to anywhere else in the country.
And how are these skyrocketing property prices in prime localities affecting the rates in other parts of the city?
When luxury property prices were shooting up, it obviously had an impact on the value of land down there itself. And if that land had to be used for, say, even if it is mid to upper end or mid to lower end of the market, it would definitely impact all those categories of market. So today, this is, in fact, the very key reason why even affordable properties in Mumbai are extremely costly. So if I have to look at rest of the country, the affordable housing there could be available for below 25 lakh rupees as well. In fact, if you leave aside Delhi and Bangalore, in rest of the country, 10 lakh is a good price to buy a decent apartment anywhere in the country. But in Mumbai, even from 25 to 50 lakh, you will have very, very few locations to reach out to as far as affordable housing is concerned. And below 25 lakh is unthinkable.
The increase in the property prices hasn't affected the demand. Data from Anarok Research suggests that housing sales in Mumbai has gone up by 48% in the second half of FY23 when compared to the same period last year.
The demand there has still been at an increasingly high rate, which is why the developers have been able to take the advantage of commanding the high prices. Because as we all know, when there's high demand, there's always a monopoly when it comes to the prices. And so far, I don't see the prices dropping anytime soon because the demand has been consistently high.
Mumbai ranks 6th among 46 cities globally in terms of annual price growth of high-end residential properties. It was at 38th spot in the same period last year, that is Q1 2022. Clearly, demand is outstripping supply and people are ready to pay the prices to land a spot in posh colonies of Mumbai. And it is driving the prices of properties in Mumbai.
Rising property prices have of late turned real estate into an attractive investment option. Let us now turn the gaze on financial markets. Tata Motors was the first Indian listed company to issue differential voting rights or DVR shares in 2008. Now, after 15 years, the auto giant has brought the curtains down on this fundraising instrument. So, is this the end for DVRs in India? Harshita Singh answers in our next report. "15 years after first issuing the differential voting rights or DVR shares, auto major Tata Motors last week announced that it is winding them down. The company came up with the DVR issue in 2008 to raise funds without diluting its ownership. DVR shareholders carry a tenth of the voting rights of ordinary shareholders with entitlement to a 5% higher dividend. With Tata Motors extinguishing its DVRs, analysts believe the instrument has run its course and the Indian market is unlikely to see any such issues ahead.
In the last 15 years since Tata Motors DVRs came into existence, there were 3 other DVR issued by Future Retail, Gujarat Inari Coke and Jain Irrigation. And other than Tata Motors, Jain Irrigation is the only one which is quoting, and that too at a 40% discount. Volumes have been decent only in Tata Motors DVR, and now with this cancellation and exchange, DVRs would become a forgotten instrument. But yes, the truth is that it was quoting at nearly 40 to 50% discount most of its 15-year life, and this discount reduced only when the announcement of cancellation happened. So I doubt whether any listed entity would actually have plans to issue DVRs, at least in the foreseeable future.
Notably, DVR shares have been fairly popular overseas, used by companies such as Berkshire Hathaway, Alphabet, or Google and Facebook in the US. However, they failed to pick up in India due to not finding favor with institutional investors and the huge discount factor.
As an alternative to ordinary shares, I think Class A shares, is not a bad proposition at all if you look at globally. Globally, Class A proposition, works. Because its minority shareholders anyway, would not like to have too much emphasis on the voting rights. And at the same time, if they do end up getting slightly higher dividend, it works good for them. So from that perspective, the Class A share should work. But in India, it has not worked. Maybe, institutional investors probably did not like the concept of not having the full voting rights. So that did not work well with them. Certainly, the DVR shares also did not work on the market. In the market, rest of the places in the world, the discount between the ordinary shares and the Class A shares or the DVR shares would be around 15 to 25% at the worst. 25% at the worst. In India, the discount between the ordinary share and the DVR share has been somewhere around 40 to 55%.
Besides, as part of the cancellation scheme, 7 ordinary Tata Motors share will be issued for every 10 DVR shares. The delisting of the latter, however, will take 12 to 15 months. Choksi also notes that the arbitrage opportunity between the two stocks is largely over as the DVRs have already moved higher. The pricing differential between the DVR and ordinary share now only reflects the interest and taxation component, he said. As for the Tata Motors shareholders, the DVR cancellation will increase the stock's EPS and increase its liquidity and market capitalization as per the company. Today on August 2nd, market action will remain stock-specific ahead of Q1 earnings of Ambuja Cements, Godrej Properties, Gujarat Gas, Indigo and Mankind Pharma, among others.
He's making plans for an early retirement. Business Standard.
Tata Group, meanwhile, is also exploring manufacturing its own chipsets. India has rolled out an attractive PLI scheme to make the country a semiconductor manufacturing hub. But what is a semiconductor? Vasudha Mukherjee explains.
Imagine a situation where semiconductors stop working for a while. Your phones, laptops, computers, and smart TVs will go blank. Most cars will come to a screeching halt. Satellites will go incommunicado. Machines in operation theaters will freeze. Frightening, isn't it? Tiny semiconductors have huge responsibilities on their shoulders. They have become the backbone of modern electronics. Also known as integrated circuits, they have the ability to conduct electricity more than insulators but less than pure conductors, which allows them to play a pivotal role in more than one electronic function. In simple terms, semiconductors are materials that possess properties between those of conductors such as metals and insulators such as glass or plastic. Most commonly used semiconductor material is silicon. Silicons are infused with boron or phosphorus gas to alter how they behave when electricity is passed through them. It turns the silicon into a vessel for billions of bits of information. Unlike conductors, which easily allow the flow of electric current, and insulators, which prevent its flow, semiconductors can conduct electricity under certain conditions but not as freely as conductors. The conductivity component of semiconductors can be altered by introducing impurities through a process called doping. By adding specific impurities, the semiconductor's electrical properties can be controlled. This includes the N-type that are doped with impurities containing extra electrons that make the semiconductor more conductive, and P-type, which are doped with impurities containing fewer electrons, such as boron, gallium, and aluminium. These holes create vacancies in the crystal lattice, making the semiconductor conductive in the opposite direction. The P-type semiconductors are used in electronic devices such as diodes and transistors. The push for semiconductor manufacturing in India has become critical to reduce the supply chain vulnerabilities and to avoid over-reliance on China. In 2022, the government launched a $10 billion Semiconductor Production-Linked Incentive or PLI scheme and even offered 50% financial support for semiconductor fabs across technology nodes. However, despite numerous applications, the center struggled to find applicants that met its requirement for setting up a manufacturing plant.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
Communications and IT Minister Ashwini Vaishnaw recently said that India should get 2 high-quality proposals in semiconductor fab in the next 12 months. Well, that's all we have for you today. For more news and analysis, please log on to business-standard.com. Thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.